60 to 70% of what you pay for a premium motor oil brand does not go into the base stock or the additive package. It goes into the logo, the end cap display, and the television budget that put that logo in your head before you ever walked into the parts store. 10 brands of motor oil, 5 whose price is built on marketing spend, conglomerate margins, and licensing infrastructure that has nothing to do with what happens inside your engine. And 5 where your money actually goes to the base stock quality, the additive chemistry, and the engineering data that backs the drain interval on the label. Starting at number 10 with a brand whose retail positioning tells a very different story from its formulation origins. Number 10, Pennzoil sets the stage for everything this ranking is about. A quart of Pennzoil Platinum Full Synthetic and 5W30 retails between $4 and $5, which puts it at the lower end of the premium shelf. The issue is not the price. The issue is what that price buys relative to what you think you are buying. Pennzoil has been a subsidiary of Shell since the early 2000s, when Shell absorbed the Pennzoil Quaker State Company in a deal valued at approximately $1 billion. Shell's downstream lubricants division, which includes both Pennzoil and Quaker State, reports gross margins in the range typical of major branded lubricant operations, estimated between 40 and 55% at the retail level after accounting for additive costs and distribution. The base stock in Pennzoil Platinum is Shell's Pure Plus technology, derived from natural gas via the Pearl GTL plant in Qatar, which is a legitimate and documented technical differentiator. But here's what the shelf positioning omits. Quaker State, sold in the same store for roughly 30% less per quart, shares the same parent company, the same base stock pipeline, and several viscosity grades, a substantially similar additive framework. 2 brands, 1 holding, 1 upstream source, 2 very different retail price signals. The result, you are not buying a differentiated product. You are buying a brand tier within a single corporate portfolio designed to capture consumers at multiple willingness to pay levels simultaneously. Pennzoil has a real technology story behind it, but among the major branded oils at this price point, the holding structure is only the beginning of what this ranking uncovers. Number 9, Mobil 1 takes the brand premium logic considerably further. A 5-quart jug of Mobil 1 Advanced Full Synthetic 5W30 retails between $30 and $38 depending on the retailer, placing it among the most expensive conventional channel motor oils on the market. Mobil 1 operates under ExxonMobil, a publicly traded corporation that in recent fiscal years has reported lubricants segment margins that, according to company filings, contribute disproportionately to downstream profitability relative to volume. The brand's marketing infrastructure is substantial. Mobil 1 holds long-running motorsport sponsorship agreements, including Formula One involvement, that independent industry analysts have estimated costs in the range of tens of millions of dollars annually across team and series level contracts. That spend is not a research budget. It is a brand perception budget, and it is passed directly to the consumer in the per quart price. The formulation itself is competent. Mobil 1 uses Group 4 POW base stocks in many of its grades, which is verifiable and legitimate. A documented multi-year study comparing field drain intervals across synthetic formulations showed Mobil 1 performing within acceptable parameters at extended intervals. But the performance gap between Mobil 1 and several oils at 60% of the price, using the same Group 4 base stock category and equivalent API and ILSAC certification, is not supported by independent dyno data or wear metal analysis at a level that justifies the markup. You are paying for the paddock presence, not the pour. Verdict: the premium is paid for a motorsport association, not a demonstrably superior additive package. If the motorsport marketing model seems like an extreme case, the next brand on this list turns the dial to a different kind of premium entirely. Number 8. Castrol Edge extends the story into the pharmaceutical-style branding of motor oil. A 5-quart container of Castrol Edge full synthetic retails between $30 and $36. Castrol operates under BP, the British energy major that acquired Burma Castrol in 2000 for approximately $4.7 billion. BP's lubricants division, of which Castrol is the flagship consumer brand, uses the acquisition price as a long-term amortization basis that industry analysts note continues to influence per-unit pricing strategy decades after the deal closed. Castrol's retail marketing leans heavily on the concept of titanium, specifically the Titanium Strong campaign that implies a metallurgical additive delivering measurable protection. A review of Castrol Edge, SDS, and treat rate disclosures shows the titanium-based compound in question is an organometallic friction modifier present at concentrations that lubrication engineers describe as functionally comparable to molybdenum-based friction modifiers found in oils at significantly lower price points. The performance claim is not fabricated, but the ingredient is marketed at a level of exclusivity that its actual chemistry does not warrant. For the consumer, the premium is paid for a brand narrative built on a titanium word association, not on a proprietary additive architecture with a meaningfully different wear profile. Wait until the brand 2 positions up from here, because the conglomerate structure this ranking has been building toward becomes impossible to ignore once you see the same stamp on 2 products priced 40% apart. Number 7, Valvoline demonstrates what a wholesale and retail markup stack looks like when applied to a brand that has successfully decoupled its price from its formulation tier. Valvoline Advanced Full Synthetic retails between $28 and $34 for 5 quarts. Valvoline became an independent, publicly traded company after Ashland spun off its lubricants division in 2016 and subsequently was acquired by Aramco, the Saudi state energy giant, in a transaction completed in 2023 for approximately $2.6 billion. The acquisition context matters here. Valvoline's retail business, which includes both the product line and the Valvoline Instant Oil Change Service Network, was valued partly on brand equity, meaning a significant portion of what Aramco paid was for the name recognition and the retail footprint, not the base stock chemistry. Valvoline's product line uses a mix of Group 3 and Group 4 base stocks, depending on grade and product tier, which is a standard industry configuration. Independent use oil analysis data collected from consumer-submitted samples shows Valvoline Advanced performing adequately within its rated drain interval. The problem is the retail markup structure, from production cost to shelf price. Industry estimates for nationally distributed synthetic motor oil in this channel suggest a multiplier in the range of 3 to 4 times formulation cost, a gap that for Valvoline's price tier exceeds what the technical specification differential from lower-priced API equivalent alternatives justifies. Verdict: you are buying a service network brand that priced itself upward during a decade of brand consolidation, not a formulation that outperforms its certified peers. Number 6 marks the peak of the first half of this ranking, and it is the entry that best illustrates why the consumer channel for motor oil is structurally designed to obscure value. Number 6. Havoline, sold under Chevron's Texaco brand family, represents the most egregious example of the holding strategy this ranking has been documenting. Havoline Full Synthetic retails for roughly $25 to $30 per 5 quarts. Chevron also produces and sells Supreme in its own Chevron-branded synthetics. All 3 product lines are manufactured within Chevron's integrated lubricants operation, which sources base stock from Chevron's own hydrocracking and hydroisomerization facilities, producing what the company calls isosyn base oil, Group 2 Plus, and Group 3 product. The Havoline brand specifically carries a legacy marketing investment that dates to its origins as a standalone refiner and was preserved through the Texaco acquisition as a distinct retail identity. The result is that a consumer buying Havoline at the premium end of the Chevron family shelf is paying for a brand architecture that exists primarily to capture retail segmentation value. An independent third-party used oil analysis comparing Havoline, Supreme, and Chevron-branded synthetics within the same viscosity grade shows wear metal profiles that are not meaningfully differentiated. The base stock is the same source. The additive package shows minor formulation variation. The price difference is the brand tier. 2 products, 1 upstream facility, 1 company, 2 different consumer identities. Your money does not cross a formulation line. It crosses a marketing line. Before the second half of this ranking, there are 3 things you can check before you buy any motor oil that will tell you more than the label is designed to tell you. First, look up the API and ILSAC certification on the label, then look it up on the API's public licensee database. If 2 oils at different prices carry identical API, SP, and ILSAC GF6A credentials, the certifying body has confirmed they meet the same minimum specification. The premium oil may exceed the minimum, but you need independent data to prove it, and that data rarely appears in the brand's own marketing. Second, search the oil's name plus used oil analysis, or UOA, on any major enthusiast forum, BIDOG being the largest public repository of consumer-submitted oil analysis results. Wear metal data from actual engine use at stated drain intervals is more predictive of real-world protection than any motorsport sponsorship. Third, find the parent company and check whether it produces a private label or store brand synthetic within the same API certification tier. If the same refinery supplies both a $35 branded quart and a $17 store brand quart with identical API credentials, the question you are actually asking is how much of that price difference reflects chemistry and how much reflects the cost of the name. Every ranking on this channel runs these same checks. No brand arrangements, no sponsored positions. If that kind of analysis is useful to you, you know where the button is. Number 5 stands out as the first brand on this list where your money has a genuinely different destination. Number 5, Kirkland Signature Full Synthetic, sold exclusively through Costco, retails at approximately $22 to $25 for two 5-quart jugs, roughly $11 to $12 per 5 quarts. Kirkland Signature operates as Costco's private label, and in the motor oil category, the product is manufactured by Warren Distribution, one of the largest private label lubricant producers in North America, under contract specifications that meet API SP certification. This is verifiable through API's public licensee database. The Kirkland model eliminates the wholesale intermediary entirely, removes the national advertising budget, and passes a substantial portion of that structural saving to the member price. A Costco internal analysis cited in trade press over multiple years has indicated that Kirkland private label products are designed to meet or exceed the national brand specification at a margin target that allows meaningful consumer savings rather than margin maximization at the consumer level. Used oil analysis data submitted by consumers to independent forums consistently shows Kirkland Signature performing within expected parameters for a Group 3 full synthetic at drain intervals up to 7,000 to 8,000 miles in normal service. There is no motorsport association, there is no titanium branding campaign, there is a certified base stock, a certified additive package, and a direct-to-member pricing structure. Here, what you pay for is in honest alignment with what you receive. Number 4 takes a direct approach to the transparency gap that defines the first half of this ranking. Number 4, Schaefer's Specialized Lubricants. A quart of Schaefer's Supreme 9000 full synthetic retails between $12 and $15, placing the total cost of an oil change at a level most national brands cannot match without a rebate event. Schaefer's has operated as a family-owned manufacturer since 1839, continuously, without acquisition by a major energy conglomerate. The company manufactures and blends its own lubricants domestically at its Street Louis facility and publishes detailed product data sheets that specify treat rates and additive chemistry at a level of transparency that is unusual in the retail lubricant market. Schaefer's Supreme 9000 uses a Group 4 PAO and Group 5 ester-based stock blend, a formulation class that carries higher raw material costs than Group 3 and is typically reserved for racing and heavy-duty applications. The company holds a U.S. patent filed in the early 1990s covering a moly-based friction modifier compound, the Micron moly additive that appears across its product line, and the compound's wear reduction claims are supported by third-party dynamometer testing data published in independent automotive engineering contexts. The absence of a conglomerate holding means the pricing reflects formulation cost and domestic manufacturing margin, not brand equity amortization from a multi-billion-dollar acquisition. Verdict: for the consumer, the premium over private label is paid for documented additive chemistry, not for a logo. Number 3 delivers a level of science-backed transparency that is largely absent from every brand examined in the first half of this list. Number 3, AmSoil. A quart of AmSoil Signature Series full synthetic retails between $11 and $13 direct, with the 5-quart cost of change landing materially below the national branded competitors on this list. AmSoil is privately held, founded in 1972 as the first motor oil to receive API service classification as a full synthetic, a distinction documented in API's own historical records. The company operates primarily through a direct-to-consumer and dealer network model that eliminates the traditional wholesale and retail distribution markup chain. AmSoil publishes independent third-party test data on its flagship products, including results from ASTMD, 4,172 wear, SCAR testing, and industry standard oxidation stability benchmarks at treat rate and test condition transparency levels that are uncommon among retail brands. A 35,000-mile drain interval claim on the Signature Series line is backed by AmSoil's own extended drain testing protocol and corroborated by a consistent body of consumer-submitted used oil analysis data, showing wear metal profiles well within acceptable parameters at intervals that would require 3 to 4 changes with conventional synthetic competitors. The direct distribution model, the published test methodology, and the decades of independent data represent a fundamentally different operating logic from a conglomerate brand managing a portfolio of retail identities. Verdict: here, the science is in the product, not in the sponsorship contract. Number 2 operates on a fundamentally different model from anything in the first half of this ranking. Number 2, Royal Purple. A quart of Royal Purple HPS High Performance Street retails between $10 and $13. Royal Purple is owned by Calumet Specialty Products Partner, a publicly traded specialty refiner, which is a different conglomerate structure than the major energy giants, but with an important distinction. Calumet acquired Royal Purple in 2012, and the brand has maintained a separate technical identity centered on the Cinerlec additive technology, a proprietary additive package protected by a U.S. patent filed in the early 1990s and covering a specific type of polar additive designed to enhance film strength above the base stock's inherent viscosity contribution. Published ASTM wear scar testing conducted by Royal Purple and corroborated in third-party industrial lubricant evaluations shows the Cinerlec technology delivering measurable film strength improvements at elevated temperatures compared to equivalent viscosity Group 3 synthetics without the polar additive system. The SAE, technical documentation around polar additive chemistry, is public record and supports the mechanism the product claims. The Calumet acquisition introduced a holding structure, but the technical differentiation in the additive package has remained verifiable through independent industrial test data in the years following the acquisition. The result is a brand where the premium reflects a documented, patented, and independently corroborated formulation difference. For the consumer, this is the closest thing in the retail channel to a provable performance gap backed by a chemistry that is not just a marketing word. Number 1 closes this list as the outlier the industry does not spend advertising dollars telling you about. Number 1, Liquimoly. A quart of Liquimoly Molygen New Generation full synthetic retails between $10 and $13 per quart. Liquimoly is a German company founded in 1957, family-controlled until its acquisition by Worth Group in 2018. Worth is a German family-owned industrial distribution conglomerate and is not publicly traded, which means the margin pressure dynamics that drive publicly traded energy conglomerates to maximize consumer channel pricing do not apply in the same way. Liquimoly manufactures exclusively in Germany at its Ulm facility, and its product line has received the top ranking in the ADAC motor oil test, Germany's largest independent automotive club evaluation, in multiple consecutive years, a distinction that is publicly documented and not a proprietary claim. The Molygen technology incorporates an organomolybdenum additive compound whose friction reduction properties are substantiated by ASTM dynamometer data published independently and referenced in SAE technical papers. MO-DTC-based friction modifier chemistry. Liquimoly publishes formulation datasheets and holds multiple active European and U.S. patents covering specific aspects of its additive treat rate methodology, filed over a period spanning from the late 1980s through the 2010s. The result is a motor oil whose retail price reflects German manufacturing cost, family ownership margin discipline, and an additive package with a documented, peer-reviewed technical basis at a total cost of change that competes directly with and frequently undercuts the nationally marketed brands that open this ranking. And for the consumer, the price reflects what is in the bottle, nothing else. Across the 10 brands analyzed, one pattern stands out above the rest. In the retail motor oil channel, price is most reliably a function of marketing infrastructure, conglomerate acquisition cost, and brand tier positioning within a holdings portfolio. It is least reliably a function of base stock grade, additive chemistry, or demonstrated wear protection. The brands that have the most to say about their protection systems say it with test data and published formulation sheets. The brands that have the most to say about their performance say it with motorsport graphics and titanium terminology. In an industry built on the assumption that consumers cannot read a used oil analysis report knowing what actually backs a protection claim is the only thing that protects your engine and your wallet.